Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, all our RetailStat customers out there. Welcome to today's Rite Aid Analyst discussion webinar. So this is Michael Blackburn. Also have Taylor Ricketts on the call today. This was kind of an impromptu webinar based on a lot of the phone calls and questions we were getting last week. We thought it'd be an important time to get out there and present the facts that we know and the reports that we're seeing and our view on what's going on exactly with Rite Aid right now. We'll start with just a quick update on the first quarter results, looking at their cash flow, liquidity, and their outstanding debt, their revised guidance, and then kind of follow up with the reports regarding the consultants and the opioid litigation and all the other concerns that kind of been prompted over the last week or so. We'll take questions and answers at the end of the call. My prepared remarks should be about 10 or 15 minutes, but the real focus again is on allowing our customers, you guys, to kind of ask those particular questions up front. What are you concerned? What aren't you unsure about? Just go ahead and type those in throughout the presentations, and again, we'll address those at the end. Starting off with the first quarter numbers. First quarter revenues, total revenues fell about 6% to $5.7 billion. That number actually, even though it was lower, did beat expectations. Comps were up. The retail comps were up 8.4%. That was led by pharmacy sales up 13%, while the front end was down around 4.5%. So the front end, again, higher margin business. So that was a bit of a concern. And management expects the strong trend in script growth to persist through the year, while front end will remain pressured. On the pharmacy services side, or the Elixir business, those revenues were down 30%, primarily on lower Medicare Part D plan membership and the loss of a large commercial client. The company delivered total adjusted EBITDA of $92 million. That was down 8% year over year. EBITDA margin for the quarter slipped 10 basis points. From the lower front-end sales, the lower Elixir sales, also lower contribution from the COVID-related sales in the pharmacy. Those are higher margin, and they benefited the results in the prior year as this vaccinations and testing continue to trail off. That's been put pressure on their overall marginal profitability. And trailing 12-month EBITDA margin is now just 1.8%. So very low profit margin there. So last year, they closed 145 stores. In the first quarter, they closed another 27 stores. So store closures are continuing. Along with reporting the first quarter results, management also announced its decision to exit the individual Medicare Part D business this January. A little insight on that decision. Rite Aid changed its pricing structure for the Part D plans earlier this year. That created an unfavorable member mix shift. Essentially, it's a situation that created what in insurance terms is called adverse selection, where you had a higher mix of less healthy members that drove up their medical loss ratio. So this decision will be a modest direct revenue headwind in 2025. Profit-wise, it should help. This is at best break-even business for them. So overall, as they focus on cutting costs related to that overall, it's going to have a positive impact, hopefully, in future periods on their overall profitability. But again, that business the individual Medicare business will be discontinued as of January 2024. The one question is, what type of impact will that have on cross-selling of retail scripts? Management initially said it's not going to be significant, but that is an unknown variable. So that's the operating trends. Looking at their cash flow, liquidity, and debt, during the quarter, they burned $424 million in cash on the lower earnings. Also, they saw a buildup of their accounts receivable, Elixir rebates for manufacturer rebates, and the receivable for the Center for Medicare and Medicaid Services, which we've been covering for a time being now. At quarter end, that receivable was up to about $170 million. So typically they monetize that as it builds up above $200 million. They sell it. They have a plan in place with Bank of America where they sell the receivable, collect it now at a discount. Usually it's like a 5 or 6% discount. So that helps their cash flow overall. Liquidity at quarter end was nearly $1.2 billion, primarily though just over $1 billion in availability under the $2.85 billion revolver. So they had pretty good liquidity. Looking at their cash burn over the last year, they should be able to get through this year technically, assuming their working capital holds. There's no major deterioration there, specifically with accounts payable, and they are receiving this, say, normalized trade terms from the vendor community. At quarter end, the end of the first quarter, their AP was actually up around 5%. So it was up slightly. No major change there then that we've seen at least through the first quarter ended June 3rd. For the year, they are expecting some benefit as they reduce their prescription brand inventory, and they're also rationalizing some of their SKUs, particularly some of their seasonal merchandise. And again, as I mentioned, they continue to sell their CMS receivable. As for their capital structure, they've got $3.35 billion in total debt. So they are highly leveraged. Their debt to EBITDA at the end of the quarter was about 8 times. Most of that debt, $3.15 billion of that debt, is secured debt, with a small portion, is $187 million, is unsecured. All the debt is not due until 2025. The next major maturity is the 7.5% senior secured notes due in July 2025. So they don't have anything imminent in terms of things they need to refinance in the next 6 months or so, which is obviously a positive. The one thing I would say, though, with the maturities, the revolver, they've got a $400 million term loan and a $2.85 billion revolver. They're both due in August 2026, but this credit facility does have a springing covenant or springing maturity related to it. If they don't refinance or repay these notes or push the maturity out at least 91 days past this August 2026 note, then they become due within 90 days of this maturity. So that is something to throw out there. So technically, let's see, that's an April maturity of these bonds, if assuming these remain outstanding. The bottom line, no major debt maturities and pretty good liquidity. Along with their first quarter numbers, the company revised its guidance. On the positive end, they raised their revenue guidance, particularly on the retail side and also the elixir side. On the retail side and the pharmacy side, they're looking at stronger sales of certain diabetic and weight loss drugs that they saw in the first quarter. They expect that trend to continue. However, despite that improvement on the revenue side, they did cut their EBITDA guidance by about $10 million, primarily related or all related to the elixir side. The retail EBITDA guidance was not changed. Elixir is still seeing a lot of margin pressure, so that came down to adjusted EBITDA guidance of around $330 million to $360 million. So at the midpoint, that's about a 20% drop from fiscal year 2023. Along with that, they cut their capital expenditure guidance by about $50 million. All right. So as I mentioned, that we're looking at continued store closures. We also expect them to continue to burn cash. Now, if we take the $330 million low guidance, hit that by another 5%, we get about EBITDA of around $310 million. CapEx now is cut to about $175 million. They're looking to have about $275 million in interest expense for the year. So combined, that would result in about $140 million cash burn before we look at any working capital changes. So that's a big of a question mark. So even on the outside end of performance, where you might see a $300 or $400 million cash burn, again, they've got that $1.2 billion in total liquidity at the end of the first quarter. And obviously, their cash flow requirements do swing throughout the year. So even with that, we do expect liquidity to be okay. So finally, looking at their challenges and what's going on, we have a situation where Rite Aid's operating with underperforming stores. They've got a eroding pharmacy services business, the elixir business. They've got a leveraged capital structure. They've got negative cash flow, right? A lot of headwinds. They've also, though, have no major debt maturities and a liquidity situation which should technically get them through fiscal year 2024. So as the company continues to face these headwinds, declining front-end sales, declining COVID revenue, and the declining elixir business, they have implemented a turnaround program. So that's ongoing. The focus right now is on cutting costs, cutting overhead costs. As I mentioned, they're cutting their capital expenditures. On the revenue side, they're looking at some low-hanging fruit. Namely, they have a new prescription adherence programs to kind of improve their prescription sales, sending out reminders to the script holders and things like that. So that did have a positive impact in the first quarter, and we do expect some continued revenue impact from that throughout the rest of the year. And again, they did bump up their guidance on the revenue side, primarily on the prescription business, to help their overall top line performance this year. They're also cycling some supply issues with the new perishables goods supplier that disrupted their first quarter business. They're working on lowering their shrink. Shrink in the first quarter was a $9 million incremental impact. So they're only generated about $92 million in EBITDA the whole quarter. And $9 million hit was just from the incremental shrink impact. So they are working on that. They've got a new head to kind of oversee that. And they are looking again at improved trends overall in the second half. With that said, we don't see these issues being enough to produce a real turnaround in Rite Aid's long-term outlook or significantly improve their competitive positioning. To that end, the company is still looking to bring in a new CEO following the unexpected departure of Haywood Donegan back in January. Beyond those legacy issues, the other major concern is the outstanding opioid litigation. Rite Aid has settled a few small cases, but they have not yet accrued a liability for that large multi-district litigation, which involves over 3,000 state and local government cases. However, we do expect a settlement announcement this year, similar to the approximately $5 billion announcements last year by CVS and Walgreens. Now, those are going to be paid out 10 to 15 years, respectively, by CVS and Walgreens. So it's not an immediate cash flow hit, but it is an annual cash flow requirement. So if we kind of extrapolate, what could Rite Aid's liability be based on CVS and Walgreens? And Rite Aid has done less than 20% of their volume in previous years, and currently it's in the 15 to 17% volume range compared to Walgreens and CVS. So if we just say, well, maybe it's about a $1 billion hit at the high end, or that could be about $100 million cash flow hit going forward. Obviously, that's not nearly as big as Walgreens and CVS, but for a company that's already burning cash, they've got a poor outlook. That's another kind of pressure on their overall profitability and their overall viability. With all this to contend with, Rite Aid did disclose earlier this year it hired consultants. They would not disclose who those consultants are, but fairly reliable reports did indicate it was Guggenheim Securities and Alvarez and Marshall as financial advisors and Kirkland and Ellis as legal advisors. The only thing they did comment regarding this action is that we believe we have adequate liquidity. We will evaluate alternative sources of liquidity and other transactions to optimize our capital structure and asset base. We may seek additional deal leveraging or refinancing transactions, and that could include a debt for share exchange of debt for shares of their common stock, so a debt for equities swap. So then last week there were a number of headlines about Rite Aid and bankruptcy. One was from a source called Seeking Alpha, and that's a content sharing reporting business. It's not an official, it's not like a Wall Street Journal or Bloomberg report or anything like that. Individual investors kind of upload their own stories and takes on the company. In that headline was the word bankruptcy. Throughout, even within that reporting, there was no discussion of any imminent risk or that there was evidence that this is currently being anticipated. The other headline was from a company called Reorg, and they deal with debt restructuring, distressed debt situations, and they do a lot of reporting on that end. And again, within that article, there was a point that this is not an imminent threat. or doesn't appear to be an imminent threat. The bottom line, so what does this all mean? What might the consultants be doing? And is a bankruptcy imminent? Rite Aid's debt, we talked about the structures of the debt. Most of it's secured. Even the secured debt is currently trading around 50 cents on the dollar. So what we could foresee is a scenario where the rate and the duration of the notes might be extended. They could attempt to refinance the current notes at a discount price, a so-called distressed debt exchange, though we are not really certain that that's possible in the near term, given the higher interest rates, market volatility, market uncertainties, and the higher lending standards by banks. So, their ability right now to refinance their debt looks a little difficult. The debt for equity, as I mentioned, could also be a scenario. And if they are able to renegotiate that with their current debt holders, even if they got rid of half of their debt, that's only about $140 million in cash flow interest savings during the year. And as we were discussing, at best that gets them to break even. They don't have the capital then to pursue significant turnaround initiatives, particularly focused on the top line, the revenue side of the business. So based on what we do know, though, and even though, again, liquidity is adequate, there's no near-term debt maturities, we do see that the near-term risk of restructuring is growing. And that is a concern for us overall. So that's the extent of my prepared remarks. If anyone has any specific questions, I think we do have a few. I'm going to try to break that out and see if we can get to some of these questions. First question was, are you seeing any decrease in trade support since the earnings release and recent news on a possible restructuring? Our APS score, our arms payment score, has been pretty stable through June. We're just getting in new data, so it's a little early to say. And obviously, this all just broke within the last week. So up till last week, things looked fairly stable. They continue to pay mostly on time, a little bit slower than they had historically, but better than they had, coming into this year and in early 2023 when we saw some issues with payment. So that does appear stable. And again, as I mentioned, at the end of the first quarter, year over year, accounts payable were actually up a little bit. How valid are the sources creating the headlines being published? Are they credible? As this relates to the comment in the last slide, near-term bankruptcy concerns increasing. Again, I don't put a lot of faith in this Seeking Alpha story. It's a content sharing platform. This is not a Wall Street Journal level or a Bloomberg level type of reporting. There's been no rumor or speculation or any reports that I've seen that indicate that Kirkland & Ellis is there specifically to deal with the Chapter 11 filing. Now, with that said, I think Chapter 11, given all the concerns that we have about this account, Chapter 11 must be on the table. And if it's not necessarily a question of if, but maybe more when. And I think the risk of, even though that this year we thought it's probably not going to be the year, they've got the liquidity. These types of reports obviously have a tendency to build upon themselves. And there's that concern that, this could type of snowball into some unintended consequences. So even though we don't feel that had to happen this year, that this does create an increasing risk of a more near-term bankruptcy than it being further out on the horizon. Is the slide deck available? Yes, we can email those out, and they'll also be up on the website. Do you know if they are taking any reserves as they close stores? Well, yeah, they are taking, they're required to write off the remaining costs related to those leases when they decide to close them, including obviously the rent expense related to that. Now that creates a situation which is known as dark store rent, which is another concern. That though, through the first quarter, they only paid about $5 million in dark store rent. So if we kind of extrapolate that out, it's only about a $20 million annual hit. But as I mentioned, the number of dark stores or store closures are continuing throughout this year. I would imagine we're going to see at least 100 store closures this year. Arguably, there's several hundred additional underperforming locations that they could close. I'm not sure how many of these stores are up for where the lease is due or the lease is terminating in the near term versus maybe out 4 or 5 years. So that obviously is a major concern as well. The dark store rent issue, and, beyond just debt financing and liquidity concerns, the dark store rent could be a growing issue as well. Are there any other questions out there? The other thing I'll talk about briefly on the opioid litigation, and in terms of their whole overall restructuring talks, this has to be part of the conversation, right? I mean, how are they going to handle these claims? How are they going to be able to pay for these claims? Ultimately, any restructuring plan, whether in the court or out of the courts, would have to include how they're going to deal with the outstanding opioid litigation, which will be significant for them.
And Mike, so first of all, fantastic. I just had one quick comment. It's not just Rite Aid that has professionals. Through our network, like all the banks have hired professionals to help represent them. Really, all sides have somewhat taken this a step further. As you said, Chapter 11 has to be on the table at some point, not really a question of if, but when. And there's a scenario here where a lot of people in this call are trade manufacturers. It could be some type of prepackaged deal where trade's whole and Rite Aid goes through some type of formal debt for equity restructuring, is able to kind of get out of a lot of these dark store leases, move past these opioid challenges. But there's also scenarios where trade creditors could be impacted. And I think you've said it exactly well. This is probably no longer one of those that's a quarter-to-quarter concern. It's now more month-to-month, even kind of monitoring as closely as possible because the situation is evolving.
Right. And final question, or more of a comment, but a bankruptcy will help with their debt, but how much will it help trade support go away? On the debt side, again, let me address that part of the question. Most of it is secured debt. There's not a whole lot of unsecured debt, which would fall in, the general unsecured claim.
It's over 90% secured.
Yeah, it's $3.15 billion of existing debt, and that could increase based on the revolving drawdowns. And you're right. How much would it help them if they do hit the trade with a bankruptcy filing? And I think, to Taylor's point, I think a prepackaged deal where they somehow work out a new deal with the debt holders. They do swap some of that secured debt for equity in a new company. And there is some type of valid plan for dealing with the opioid litigation, while also, and more importantly, a plan to A, get out from those remaining underperforming locations, and B, find a restructuring plan that's going to really help ignite the top line performance of the existing retail stores. And what do you do with the Elixir business? That could be sold. They bought it in 2015 for about $2 billion. It might be worth $1 billion right now, probably less, particularly in a reorganization situation. But that could help them restructure and be more focused on the retail side of the business. There really are no synergies between, or very little synergies between Rite Aid Retail and the Elixir Pharmacy Services business. We've been tracking that, and I made this comment many times in the past. Their inter-segment revenues between the two businesses continue to fall, and that they fell again in the first quarter period. So that means there's actually lack of synergies between those businesses, and they're not helping grow the retail side. So there's really no reason for them to continue to hold on to this business, particularly given some of the headwinds that Elixir and the pharmacy business management business overall is facing. think that's the end of the questions. Feel free to follow up with me directly if anyone has any follow-up questions. Actually, wait, one more. How would a bankruptcy now affect their opioid lawsuit? You know, it's a difficult question, and again, the key point being they have to address it one way or the other. If they did file a bankruptcy, and we did reach out to an attorney, and according to that attorney, these would fall into, you know, it would not be a priority claim. It would be an unsecured claim. So it obviously would further dilute the unsecured claim pool. But I think there are other political issues with them being able to just walk away from an opioid litigation at this point. So I think that, again, ultimately, they need to get a plan together on how they're going to settle those claims in the long term and incorporate that into their overall restructuring plan. Another question, is there an update on stockholder suits against CVS and Rite Aid due to opioids? You know, the stockholder suits, no major updates right now. They haven't, again, accrued any significant liabilities related to any of those suits, so unfortunately, no. I do think the multi-district litigation is really where most of the risk is in terms of the opioid situation. There are a few holdout states that have also subsequently settled with CVS and Walgreens. New Mexico, there's a couple of counties in Ohio, Long Island. Most of those have now been settled, and you know they were significant, but not to the tune of $5 billion, more in the hundreds of $millions in terms of how Walgreens and CVS had to deal with it. So Rite Aid will probably face some of those risks as well. And will this recording be available? Yes, we'll have it up on the site within the next day or so. Okay, so that takes us to the end of the call. I want to thank everybody again. And again, if you have any questions, feel free to reach out. Thank you.